folks, we're going to go ahead and get started. Again, welcome to After Hours Live with Gordon Asset Management. This is what I hope to be the first of a series of more frequent events that we do, just to allow folks to drop in, ask questions that they may have about the markets and various things that are happening in the world. So just a quick about your team. So today we have myself, Todd Zempel. I am head of the Retirement Plan Services division of the firm. We also have Glenn Moore, who co-chairs the Investment Policy Committee with Joe and really heads up the individual wealth management side of our practice. And last but not least, the man, the myth, the legend, Joe Gordon, managing partner and founder of the firm. So let's go ahead and dive right in again. So disclosures, because we are an SEC registered investment advisor. Even though we are an investment advisor, this is not deemed to be investment advice, right? This is just educational purposes only. Go ahead and read the disclosures there. Take note of every single word listed there. It's very important for compliance purposes. That said, let's go ahead and get right into the presentation. So we do have some slides that we want to cover. I will kick off the presentations with some very high-level thoughts and commentary on investing in general. Then I'll hand it off to Glenn to provide a little bit more insight into the markets and some of the volatility that we've seen lately, and then end the presentation with any Q&A. As we go through the presentation, if you'd like to submit a question that you didn't submit when you initially registered, you can just do that via the chat function in the GoToWebinar portal. So again, submit questions via the chat and we will address those at the end of the presentation. Big picture, asset class returns. This chart that you have in front of you is what we call the quilt chart. So the quilt chart here shows asset class returns by the various asset classes since 2007. And if you look at this chart, you can see it's very confusing, very hard to draw any kind of conclusion about the data. But if we look at year to date, for instance, how things have played out thus far, you can see commodities have been the best place to be investment-wise year to date. They're up 33%. Cash is the second best place to be year to date when you're basically break even. The other sectors you can see have all lost money. Fixed income, so bonds have lost money to a great degree, down 10% year to date. You can see the asset allocation portfolio, and I'll come back to this in just a moment, is down about 10% year to date. High yield bonds down 12%, so on and so forth. The worst performing segment of the market year to date is small cap, down over 17%. These are just the major asset classes. They're not the individual sectors. Obviously, technology and energy, they've all done very different things, but these are the broad asset categories. Now, the main point here is if you can see the asset allocation portfolio. So if you had a diversified investment portfolio over this time period, the returns tend to be more normalized with lower volatility. And really, that's the goal of having a diversified investment portfolio over time. Best possible result for the lowest potential volatility. And again, this is investing 101. Another couple interesting points to draw from this are that you probably shouldn't rear view window invest. And REITs are a great example of this. If you look at REITs and their performance over the past few years, you can see year to date, they're down about 14%, but last year in 2021, they were the best place to be, up 41. But if you just go back a year prior, they were the worst place to be. And then the year prior, one of the best places to be. So if you're choosing your investment options based on what did the best last year, it's probably not the best way to go about it. Next slide. This is, again, big picture slide, time diversification and volatility. So if you look at various rolling periods in time over history, Stocks, for instance, if you look at any 1 year rolling period of time from 1950 to 2021, the best 1 year period, stocks were up 47%. The worst 1 year rolling period, they were down 39%. Bonds, the blue bar, you can see the best year, they were up 43%. The worst year, down 8%. Obviously, 2022 hasn't been factored in yet, but they might actually be the worst year. And then when we look at a 50-50 portfolio of stocks and bonds, you can see the best 1 year period, we would have been up 33%. The worst year, you would have been down 15%. But that's just the 1 year period. So in any 1 year period, investing can be extremely volatile. But if you take a step back and look at rolling 5 year, 10 year, and even 20 year periods, the volatility tends to nullify. So let's look at 10 year, for instance. In stocks, the best period over 10 year rolling period, stocks were up 19% per year, annualized. The very worst year, they were down 1%. So very low probability of losing money over any 10-year period in stocks. There were periods when that happened, and we'll touch on that in a minute. But there's a very low likelihood of that happening. Bonds, the best year up, best 10-year period, 16%. The worst period, positive 1%, so you still made money. And a diversified portfolio, plus 16 versus plus 2. Again, this is reinforcing the importance of having a diversified portfolio that includes both stocks and bonds in your portfolio. This is another really interesting chart. So looking at 10-year rolling average returns in the S&P 500 index. If you're not familiar with what that is, the S&P 500 is the 500 U.S. Large cap stocks. And that composite index, when you look at time periods going back to really the 30s, I think actually 1929 was the beginning of this chart. Over any 10-year period of time, the average performance of the S&P 500 has been about 10%. And when we look at rolling 10-year periods, the average rolling 10-year period has been about 15%. So over all these rolling 10-year periods, things have been pretty good if you're invested in stocks. Again, there were a couple periods where you were negative to break even. So the worst 10-year time frame was from August 31st, 1929 to 1939. You would have actually lost 5% of your invested money over that 10-year time period. Obviously, a lot of things happened in that time period, the Great Depression being one of them. So that clearly has a major detractor, has been a major detractor from performance. But as you can see, over time, generally, the stock market in the U.S. has done pretty well. And that's the idea behind investing in the stock market, right? You want to see a return on your investment. But again, having this historical context that although we may be going through a period of volatility now, things historically have done pretty well over time. And here's another interesting way to look at it as well. So each one of these bars are a year in the markets. And so the gray bar is the performance in the S&P 500 index in that calendar year. And you can see more times than not, it's actually positive. But the red dot is the potential peak to trough drawdown that happened in the S&P 500 index in that year. So you can see year to date, we're down about 18%, sitting basically at the lows of the year so far. But we go back and look at last year, you can see there was a 5% drawdown, but the S&P actually ended up 27%. And then everybody's favorite year, 2020, the year of the pandemic, this S&P was actually down 34% in that year, but actually ended up 16%. So again, the takeaway here is that market downturns happen, right? But it's a normal occurrence, and downturns don't last forever. And here's some actual data on downturns in the market, and specifically the S&P 500. So if you could see here, the size of the decline, 5% or more, happens about 3 times per year on average. And usually there's about a 43-day peak to trough time period in which that happens. Drawdowns of 10% or more happen about once a year, believe it or not. 10% is a big drawdown, but that's a pretty common occurrence. 15% or more happens about once every 3 years. And that's where we are now in the S&P 500. And then a drawdown of 20% or more happens about once every 6 years, and it usually happens over about a year in terms of peak to trough drawdown. So again, these things are normal. It's healthy for the market to occasionally correct to get rid of some excesses in the market. And then the last slide that I'll talk about before handing it off to Glenn is about staying invested. So this chart shows if you invested $10,000 in the year 2002, it would have grown this blue line here. If you just would have invested it in 2002, left it there, in 2021, that $10,000 would have grown to $61,000. But what this gray bar shows is if you missed just the 10 best days in the market, how that actually would have affected your return. So if you missed the 10 best days in the stock market, investing that same $10,000 in 2002, you would have only ended up with about $28,000. That's quite different than the 61 if you would have just left the money in the whole time. The other thing that's really, really interesting about this chart is it shows when the worst drawdowns, when the best days in the market actually occurred. And the best days in the market, the 10 best days, they're actually within all these purple bars here. They all happen within very close proximity to the worst days of the year. So what we tend to see a lot of times are that investors, they'll see a sell-off in the market and they'll go to cash and they'll sit out until they wait out the storm and then get back in. But in doing that, most folks tend to miss the best rebound days in the market. And you can see here in this little chart what the best days in the market actually were. And you can see there were a lot in 2008 and 2009 after the market essentially crashed due to the financial crisis. And then there were also a number of days in 2020, sort of on the back end of the COVID sell-off, or actually during the COVID sell-off. We had quite a few big bounces as things happen, as the market sold off. So again, the importance here is that you need to stay invested. It's really hard to do that when the market's selling off in a big, dramatic way, of course. But keep in mind that the best days tend to happen right alongside some of the worst days in the market. So before I hand it off to Glenn, just again to reiterate, if you do have questions, you can submit those via the chat function, and we'll address those at the end of the presentation. So with that said, I'm going to hand it off to Glenn to go ahead and cover this slide on the father of technical analysis, Bob Farrell.
Right. So thank you, Z. And that was a good overview of kind of putting everything into context historically and looking at the bigger picture. We're going to kind of pivot a little bit and look more in the immediate term and kind of put into context over the past, call it, really 6 months, 7 months from when this sell-off started, and then also look at historically different periods of time where we've had excesses of inflation, and try and frame this a little bit for everybody on the call. So this is Bob Farrell, as Todd mentioned. He is one of the godfathers of technical analysis, and he put together a list of 10 different rules to remember, and mainly for dealing with bear markets. And so these are pretty interesting, kind of nice things to look at. Markets return to the mean over time. So when you have excesses on the higher end and you have sell-offs on the lower end, then things tend to mean revert. Excesses are never permanent. Market corrections don't go sideways. So when you think that the worst of it is over and markets just kind of drift sideways, it's likely not the case. This is a good one. The public buys the most at the top and least at the bottom. I think that 2021 probably was a good confirmation of that, where we had basically casino-like behavior with a lot of stocks that really probably, in all likelihood, they may go to zero after this episode is all said and done. As Z touched on, it can be tough to have longer term resolve when you have volatile swings like this, and fear and greed kind of take your behavioral decision making over. Markets are strong when broad and weak when narrow. So when you have a lot of stocks participating on the upside, that's a good thing. When a lot of stocks are not hitting all-time highs or not participating, that's when you kind of see the deterioration of the market, and those can be signs that things are starting to crack. The three stages of the bear market: you have the first sell-off, which usually is fairly violent, and I think we saw that really in the first part of this year. We had a rebound, and I think that the S&P was got to being down only -5% after being down double digits on the year, and now we've kind of had this third stage, which I think we're probably in, and that's when things set in more longer term, and we have a longer period of a sell-off and drawdown. When all experts and forecasts agree something else is likely to happen, that's pretty spot on. And bull markets are more fun than bear markets. I think we can all agree on that. So next slide, Z. This is a good chart. We pulled this from, and we have a lot of charts and data from one of our partners, Hedgeye. We pay them for a lot of research, both on the market side and the economic side. And this is pretty interesting. The data only goes back to 2010. But what you're looking at is the black lines are S&P 500 index returns on a quarterly basis, and the gray bars are U.S. Treasury total return numbers on a quarterly basis. And what you can see in the first and second quarter, or at least to how far we are through the second quarter of this year, both stocks and bonds have been negative. And if you look back over the past 12 years, that really has not been a phenomenon that has happened. When you've had pretty significant sell-offs, either treasuries are generating a positive total return, or B, they're break even. And really the magnitude and the pain, there's been nowhere to hide. And so it's been an unusually tough environment to invest money and remain fully invested and generate positive returns this year. This is a chart that we put together showing really the magnitude of the carnage in the Treasury market. You can go back just to the third quarter of 2021, and the U.S. 10-year interest rate was at 1.2%. And here we are, we went up 2 percentage points, which is fairly unheard of. And just looking at the average return, or the average yield on the 10-year, and going from there to the high of 3.12, that was a 3 standard deviation move. And basically, that's almost like a black swan event. We've never had rates go up that fast, basically from the beginning of March to right in the beginning of May. And so certainly the pain in the Treasury market, it's really unprecedented. The velocity that we've seen interest rates go up in a very short period of time, and for those that know, or for those that don't know, prices and yields are inverse to each other. So as interest rates go up, bond prices go down. And so the fact that we've had this significant move upward in the yield, that means that prices have gone down just as fast. So here's another chart from Hedgeye, and this is basically looking at the historical price shocks that we've had since World War II. And so the top period, May 2020 through April 2022, that's showing the duration. So we're 24 months into this price shock, and you can see at the bottom, on average, these different price shock periods last 24 months, and so we're kind of right on schedule for where. When you have a trough in CPI, which is the inflation, it's an inflation gauge index, from the lows to the highs, which we just ticked the highs last month of 8.5% on an annualized basis. That generally lasts on average 24 months. And you can see the average change is 7.2%. And so we're a little bit higher on that. But really, to me, the more noteworthy thing is in the last column on that table, you can see in all of the prior periods, did we have a recession following these price shocks? And only one time, which was in 1949, 1951, did not result in a recession. And so that to us seems like more likely than not, are we heading to recession? This would indicate that there's a better chance than not that we are. This is another chart. This is from Rosenberg Research, which is another economic research firm that we pay, and they provide a lot of good data and put a lot of the economic information that comes out into context for us to make investment decisions. And this is focusing just on food and energy price increases on a year-over-year basis, and you can see clearly. This is we've seen increases in prices on food and energy that we haven't seen dating back to the 70s and the 80s, and the gray bars indicate recessionary periods. And so this seems to be a pretty good indicator and has a pretty good batting average on when you have these price increases. It usually means, again, that recession probably is not too far away from happening.
And it makes sense, right? If you're spending all your money on food and energy, you don't have money to spend in other places. And God knows
exactly
I'm spending a lot of money at the grocery store now. It's unbelievable.
Here's kind of a data wonky type slide, but this is looking at interest rates, which I just talked about. Interest rates going up and that was on the 10-year, and so. What the chart on the left is showing is it's showing shorter term interest rates minus longer term interest rates. And, or I guess it's longer term interest rates minus shorter term interest rates, excuse me. And so normally there's a positive spread between that, right? You would think, okay, if I'm willing to lend money for a longer period of time, I should be getting a higher interest rate. Well, you have these periods of time where actually you can get more money lending money for a shorter period of time than a longer period of time. And you would think, well, that doesn't make any sense. But what that signals is that if you can get more money lending for a shorter period of time, that must mean that you think that there's more risk in the shorter period or in the shorter term. And so that is another sign that we could be going into in a recessionary environment or have a recession. And so every single time that the shorter term interest rate is higher than the longer term interest rate, that's called a yield curve inversion. And you can see it has a pretty good batting average on calling when there's going to be a recession. And the same thing on the employment front. Employment is pro-cyclical. And so when things are great, that's when you're going to have unemployment going down and employment going up. And normally, employment is going to look the best right at the end of the cycle because you've gone through the worst, from the worst of times to the best of times. And then when there's really nowhere to go, because you've already had as many people at full, or your economy is at full employment. That's what that trough with the question mark. Are we basically at that point where there's no more jobs to be filled, or the private sector or the public sector doesn't have any more jobs to fill. And so is that number going to start going back up to a peak? And again, not to sound like a broken record, but you can see the gray bars are indicating times where we've had recession. And so there's just a lot of economic data that is flashing red, that's giving us a little bit of concern in the shorter term that we might be going into a recession.
Yeah, and Glenn, let me just add there. So I really love this unemployment chart on the right. Obviously, we're in a very strong employment situation right now. There's a lot of job openings currently, and a lot of talking heads on a lot of the financial news networks say, oh, we have such a strong labor market, there's no way we could go into a recession. But to exactly what you said earlier, unemployment's a lagging economic indicator. It's typically the last thing to break before the economy resets. And I will say, over the last couple of weeks, I've started to hear more rumblings about unemployment. They're not saying these companies are doing layoffs, but I'm hearing a lot more companies talk about, quote unquote, right sizing their workforce, or they had redundancies that they are eliminating and things like this. So it feels like we're starting to hear some of this talk about layoffs and whatnot coming, but it sounds a lot more kinder and gentler this time around.
Right. No, that's a good point. Walmart basically they admitted that on their earnings call, which was on Wednesday, and they basically said that they had overstaffed. Robinhood, the CEO, was kind enough to put that on a blog on their intranet, and basically said that they're going to cut, I think, 10% of their workforce. So that has definitely been a common theme on a lot of these earning calls, with a lot of big cap blue chip companies talking about the fact that during, or I guess kind of coming out of the pandemic, they overstaffed, and now they're going to have to basically cut back on the staff that they have full time. And so that certainly is not a good harbinger for the future. So this slide, again, from Rosenberg Research, kind of drives home one of the things where we feel there might be an opportunity to make a little bit of money, is that during different time periods where we had inflationary environments very similar to what we're going through right now, there were periods where we had recession. And clearly, as you can see, this again there's three different charts of the 10-year yield. And so again, as interest rates or the yield goes down, bond prices go up. And so all of these three are in what we call a technical term, the downward dog position, if you like to do yoga. So this is something where we see, especially with interest rates where they are now, it's not about the levels that they're at. You can see back in the 70s and even in the 80s, the levels were a lot higher than they are right now. But that doesn't really matter as much as the direction of where they go. And so if interest rates go down from here, the 10-year yield right now is right around 2.8 to 2.85%. And as we looked at on the previous chart, I think the low was about 1.2%. And so that just in using, if you have a bond fund that has a 10-year duration, and you have interest rates go down 1.6%, that's a 16% total return over that period of time. And so that's kind of how bond math works. And this is just driving home to me the charts that we had on the previous slide, is that growth matters. And so we came out of 2020, and you can see the second quarter was the worst quarter probably any of us will ever see in our lifetime, unless for some reason we go into a lockdown scenario again. But on a year-over-year basis, the second quarter GDP was down 9%, and that's never been seen, I don't even think, during the Great Depression. And then coming out of that, when you're looking at the numbers on a year-over-year basis, obviously, since 2020 was so bad, 2021 was great. Everything, we were coming out of lockdown. A lot of businesses were reopening. There was pent-up demand from consumers. And so 2021, second quarter, when you look back 1 year, of course, we were going to have probably, again, a GDP number that we'll never see in our lifetimes. But now, where we go from there is in 2022. If you look at how good 2021 was, you're clearly going to have growth slowing. And so what the chart or the slide on the previous page showed is that bond yields really pay attention to growth. And so we think that there's going to be a significant slowing of growth. And a lot of these numbers don't even have employment numbers really kind of troughing and going up. And so if the consumer is in worse shape than what we or what a lot of these GDP numbers are projecting, you could see massive revisions downward, and that would only increase the amount of slowing of growth that we could see throughout the rest of this year. So this is a pretty busy slide, but what this is showing is the impact of quantitative tightening and interest rate increases, but also the changes in financial conditions. And so this is kind of it's not an exact calculation, but what it's showing in the red bar on the left is from 2015 to 2018. When you look at the interest rate increases that the Federal Reserve did, you look at the quantitative tightening, and then financial conditions tightening as well. Essentially, there was almost 24 rate hikes. If you're looking at 0.25% increases. They did over that 3-year time period, essentially the equivalent of 24 rate hikes. Now, on the second red bar, this is just in 2022. And so if you look at the rate hikes that they're doing, they've already done a 25 basis point and a 50 basis point rate hike. They're expected to do another 50 basis point rate hike, and then who knows what they're going to do from there. But they're also letting the balance sheet roll off, so that's quantitative tightening, and then just general financial conditions tightening as well. In 2021, so just basically for this year, you're looking at the possible equivalent of 21 rate hikes over that period of time. And so basically you're trying to cram into 1 year what the Fed did in 3 years on the previous go around. And for those that don't remember, in the fourth quarter of 2018, that's when we had when Powell said that the Fed was basically on autopilot and they were going to continue to raise rates in 2019. The market started to sniff that there was going to be growth slowing, and we had a peak to trough 20% sell-off in about 6 weeks, really from right around Thanksgiving to Christmas Eve, which was the low. And so if we look at what they did over the 3-year time period and where we got to kind of from this total tightening number, they're trying to do that in 1 year. And so clearly their goal is to break the market and try and break the back of inflation. But it's going to be extremely painful, I think, if they continue on this route that they're going, because just at purely the speed that they're tightening financial conditions, it's massively quicker than what they did in 2015 to 2018. So this chart right here, this basically is showing the amount of deficit that we have from the lack of fiscal and monetary stimulus, and a lot of that was from the American Rescue Plan, and also the checks, the unemployment assistance that the government was providing. And so basically there's a $1.3 trillion hole in government spending that isn't happening in 2022 that happened in 2021. And so, Z, if you go to the next slide, it actually kind of graphically breaks it down a little bit better. You can see in March of 2021, that green part of this in the chart on this bar is showing the amount of government fiscal injection into the economy that happened with those $1,400 stimulus checks, and you can see the other $600 stimulus checks and enhanced unemployment benefits and things like that. And so just from a purely mathematical standpoint, growth slowing was going to happen in 2022 because in order to have accelerating growth, you'd have to have a bar that's higher than that. And you can see clearly to the right of that tallest bar, those bars are nowhere near the same height. And so it just shows you that the amount of money that went into the economy in 2021, a lot of people agree that, and not just partisan economists or partisan politicians, it's on pretty much consensus on both sides of the aisle that the actions that Congress and the actions that the Federal Reserve took in 2021 likely contributed a lot to where we're at now. And so, GDP, the calculation for GDP is C plus I plus G plus net exports. So that's consumption, investment, government spending, and then net exports. And so that government spending piece of the GDP equation was massive in 2021, and it's not going to be the same in 2022. So that's why you're having that growth slowing narrative. And so this is another chart from Rosenberg Research. Personal savings is at near the lower bound, and behaviorally in 2020, when people had no clue what was going to happen, they were forced into a scenario where they weren't working, and people were saving massively. But then you can see that first stimulus came in, and people felt great. So then they felt like they didn't need to save, and then that rolled off, and they couldn't go back to work, and so then savings went up. But then the second American Family or the American Rescue Plan happened, and that's when that second bar in 2021 kind of peaked, and now savings is back down to the lower bound. And so we don't have the same government fiscal policy that we had in 2021. And oh, by the way, we have massive food and energy inflation, and potentially we have the labor market rolling over. And so people are not saving. And so this could really be a bad combination for the consumer with very little in savings at this point. Here's a good tweet from Jeff Bezos. I'm not sure. It was pretty widely broadcasted in the news, but basically he's calling out the Biden administration, saying, and this was in response to when the president tweeted that if we wanted to solve inflation, we needed to tax corporations and the wealthy. And so Jeff Bezos just clearly has had enough, and he said that that's not true. And by the way, inflation hurts people the worst that are middle class and lower class. And so inflation is a regressive tax, and I think that that's spot on. And we're getting close to the end of our slide deck, but this is a pretty sobering slide. This was a poll done by Gallup, and really, to me, the top one is the most startling. This was a poll that basically asked the question: do you have enough money to pay your normal monthly bills, and are you very worried, moderately worried, not worried at all, or just slightly worried? And so the number of people, or the percentage of people that answered either very or moderately worried from 2021 to 2022 jumped 8 percentage points. So that's a 25% increase in that figure. And this is broadly there. This is not broken down. This is just anybody who answered the question. This is how they responded. And so the fact that you've seen a 25% bump in people who are very worried about not having enough to pay their normal bills, not a good sign for the consumer. The next slide actually breaks it down by income bracket. And so this goes to Jeff Bezos's tweet where he said inflation is a regressive tax that harms the middle class and the lower class the worst. People making less than $40,000. There was a 17% jump in the response to people not having enough money or very worried about not having enough money to pay their normal bills, and that's a 30% increase. And so it's really when you see these types of numbers. It gives you a little bit of pause for concern and as to where the health of the economy is. And there's another, we don't have a slide on this, but there's another figure that Equifax put out today. It was either today or yesterday, I can't remember, but the percentage of auto loans, whether it's a new car or a used car, that is in 60-day or longer delinquency is back at numbers that we last saw in 2007. And I think we all know what happened during that period of time. We had the great financial crisis where that was the worst market and economic environment we'd had since the Great Depression. So there's a lot of confirming data that we see out there that basically is giving us concern as to the health of the consumer, but also what is the market impact. And so this is a good chart from Rosenberg Research showing where you can invest your money during a recessionary time period. And clearly anything in stocks is not going to be a good place to have your money broadly. If you look on the right side where you actually have some positive returns, cash is a good place to be. But we don't advocate for all in or all out. So maybe if you don't feel confident, you want to raise a little bit of cash, there's no problem with that. But as we talked and a lot of the slides alluded to is that government bonds can be a good place to hide out and weather some of the volatility that you see in stocks. And then also just good, profitable blue chip companies. This is the Dividend Aristocrat Index, which basically owns companies that have paid dividends for extremely long periods of time, have a history of paying dividends. Those can be a good place to have money invested in those stocks. So not in the Zooms, not in the Pelotons, not in the super high growth or companies that don't generate any cash flow. Certainly would want to be avoiding a lot of those stocks because just this year, most of those stocks are down 60, 70, 80%.
So that really sums up the bulk of the presentation. But before we go into the Q&A, and I do have a number of questions, but Joe, do you have any thoughts, comments on things we didn't cover or maybe that you feel are important to discuss before we get into the questions?
Yeah, I think I would just capsule it by saying that we're in the 8th inning of a long bull market. And it's showing signs of weakness. And you can see that in that we've gone from a stock market in 2020 post-pandemic when the Fed flooded the U.S. with $3 trillion in monetary relief, and it inflated the stock market. There was a 6-week crash. It totally rebounded to plus 16 on one of your slides from minus 34. And the only stocks that worked that year typically were tech, but it was really tech, a lot of the disruptive tech like the Teladocs, the Zooms, the DocuSigns, and they were going parabolic, but they typically were not making any money to speak of. They were trading at high prices to sales and extremely high prices to earnings if they even had earnings. Then fast forward to 2021, where I think this is a connect the dot comment. We went to growth at a reasonable price, but still, because of the you could blame the American Rescue Plan, another 1.3 or 4 trillion flooded into everything in the economy, which started the inflation fire. And if you throw way too money at something, you got way too much demand, you're not going to have enough supply, so the prices are going to go up. But also the money that went into the stock market did not go in there for economic fundamental reasons. It went in there basically because people wanted to get rich, and it pushed up valuations. And so valuations were the whole story in 2021 when the market was up 26, 28%. And then you fast forward to where we are today, and in a retirement committee meeting that we were in last week, when we really looked at what was working, obviously it was said earlier, the only sector that's killing it this year is energy, and energy is the smallest sector in the S&P 500, about 6%. Many managers are reticent to allocate to energy because the government hates fossil fuels and is trying to get banks not to even invest in fossil fuels, but it's the only thing that's worked. And then if you look at, well, what broad asset classes have worked, value investing is where you need to go in the late innings of a bull market. And value investing, when we looked at small value as witnessed by the Russell 2000 Value Index, basically flat last week, year to date. When you looked at the mid-cap value index, it was negative a little bit. And when you looked at the Russell 1000 Value Index, it was basically flat. So essentially, a lot of people that are in value stocks and value investing, they were like, well, what crash are you talking about? What bear market? Because they know they're not up and they're not happy, but they like it that they haven't really lost a lot of money too. And clearly, if anyone on the call, if you were around and not in diapers in the 70s, you really know that what worked was this folly that, owning a home is a great investment. And we're seeing that play out right now because of inflation. Inflation was the sole reason in the 70s that houses became worth a lot more. It wasn't that they were great investments. It was basically inflation driving up the value of housing. We're seeing that right now, and people are going crazy trying to buy housing at the top of the market, and it's going to end really, really poorly. But broadly diversified real estate and warehouses and multifamily, we've got REITs, real estate investment trusts, that are up 6 to 11% year to date. And no one is complaining about that. So there are places to go. You have to be tactical. You have to be thoughtful. And I appreciate Glenn and Z taking the time to get into the weeds here with all these slides and show their academic brilliance.
There's a lot of big brains going on right here. Well, thanks, Joe. So you already kind of addressed it. So one of the frequent questions that I saw in the signups and through chat, the question essentially boils down to, where does somebody go to invest in the current environment? Part one, and then part two of that question, how long do you see this playing out? Joe, I'll hand that to you first, and I know you already touched on some of that with your response, but why don't you respond, and then we'll give Glenn a chance.
Your question was how much more of this malign we're going to suffer? Is that what your question was?
Right, and then where can investors go for a respite from the pain?
Well, I think you have to look at what's working short term and not get too long term in your thinking. Glenn and I are discussing Treasury bonds. Just for people that know, 30-year Treasuries are up 4% the last 2 trading days. That tends to not say, hey, it's happening. But if it persists for another 3 days or 4 days, and you'll see that with the 10-year rate probably even going further south, then that may be a place to be. But energy is going to continue to work. Also, fertilizer stocks, anything to do in the chemical industry where companies make things, their input costs are much, much higher, and these stocks are benefiting from it. So I think that will work. And also real estate. And real estate mainly because it's the one place that does perform well when you have inflation. And one thing I do want to mention about gold. Gold normally would be going parabolic in this type environment. It did so in the 70s, and silver. But the reason it's not is because the U.S. has the highest interest rates in the world, relatively speaking, right now. And so the dollar is strong. It's probably up 20% more than it should be. And we expect that to reverse. In fact, the euro is on parity with the dollar almost. So if you're going to want to go to Europe, you might as well do it now when you get an equal trade. Just for historical reference, in 2008, when oil went to 145 a barrel, the dollar euro, it took a U.S. dollar of $1.68 to have 1 euro. So that's huge, a 60% difference in currencies. And a lot of that is just the interest rates in Europe are low. The German 10-year bond is at 1%. Okay, so ours is almost 300% higher. And so relatively speaking, if you're a sovereign wealth fund, you're probably going, well, where should we park our $50 billion? Well, the U.S. dollar, probably not a bad bet at 2.85 today, and versus 1 in Germany. So there's currency risk everywhere, but that would be my thinking.
Glenn, do you have any differing thoughts on that?
No differing thoughts. I do. I agree. Gold is likely going to be a good place to have money invested, especially when some of the currency dynamics work themselves out. But just one little anecdotal point. We didn't talk about crypto at all, and what was funny is that the narrative in crypto kept on changing. It was a store of value, then it was digital gold, and then it was a method of transacting, and some of them or all of those may be true, but what we've seen in the past, I guess really last week or maybe the week before, there was one quote unquote stable coin that lost 99.9% of its value. And so that is something that played into the mania of 2000 and 2020, 2021. So you want to stay away from stuff like that and really just the boring stuff, whether it's dividend paying value stocks, U.S. treasuries or gold. I think that's probably where you're going to be able to make some money, but not lose a lot of money, I think is the more important thing.
Yeah, that's right. I mean, crypto and, that's a whole separate discussion, but, it was put out there as an inflation hedge, but really how it behaved, really this year is actually a leveraged play on tech stocks. So it's been quite interesting to see that unfold. Another question we got, and Joe, I'll pose this question to you. Obviously, we manage a lot of retirement plans for companies, and there's a lot of employees that invest their money through avenues like target date funds and balanced funds, fund of funds that are managed for you based on your time horizon to retirement. What would you say to folks investing in target date funds or balanced funds now? Is that a safe place to invest your money if you're a long-term buy and hold investor?
Well, clearly the risk in every target date fund is driven by the age of the participant. So the younger participants are going to be more like 90% stocks and less than 10% bonds, and they shouldn't worry about a thing because they've got a long runway working life to recover from any short-term pain. For the 60 plus crowd that's in the 2020 target date fund or 2025 even, or 2015, and they're not yet taking income, typically there's been more money in equities normally than there would otherwise be because interest rates have been artificially kept so low for so long. Most of the 2025 and 2020 target date funds have about 60% equities, which is basically the same as a classic 60-40 balanced fund. Some, 5% more in some cases. And then 2015 target date funds tend to be the inverse, 40% stocks. So all the pain's probably been felt there. I would say mostly from a lot of the bond managers have already taken gas, and I think there could be more pain on fixed income, but we'll see. I think, like Glenn and I have discussed often, is that I think we're in for a replay of 2018, where Powell realizes after 4 interest rate rises that he blew up the stock market. It was down 10% in Q4 2018, and he basically with Janet Yellen on a panel the first week of January 2019, asked for mea culpa from the audience because of the mistakes. And so they eased all of 2019, which made everybody happy because you recovered and your stocks all went up and the market was up big. And then we had the pandemic. So I would say stay the course. If you are concerned, I would suggest that you call our office and or email and arrange a call with Z or JT Stilley, because they know what's inside the target date funds on each particular vintage and can actually address your concerns and questions.
Thanks, Joe. Now, Glenn, I'll throw this question out to you. So we have folks asking about bonds. Bonds have obviously performed pretty horribly so far this year, but they tend to serve as the ballast, the safe place to go in your portfolio. Do they still serve as the ballast for a diversified portfolio, and or what should folks do with the bond portion of their investment allocation?
Well, that's been, I think, the toughest question of 2022 is that going to persist? And clearly it's been very difficult for bond funds right now, just broadly. And so what I would say is that I do think that bonds still do serve a place in the portfolio. And I think that anyone looking at the composition of their bonds, you should be probably at this point selling anything that's low quality, because you have a lot of different types of bonds, not just U.S. Treasuries or investment grade. You have high yield, you have mortgage backed, you have other collateralized or commingled type bond investments. And so if you're doing that actively yourself, then I would say you probably want to look at selling anything that is lower quality, so double B, single B or below, and looking at buying high quality corporate bonds or buying U.S. Treasuries and selling everything else. And if that's not your forte and you don't want to get that deep in the weeds to what your bond portfolio looks like, then I would say, you should delegate that to a manager in an actively managed fund that can skillfully navigate that. But to the long-winded answer is that I do think that bonds are going to have their day in the sunshine, because as one of the rules of investing from Bob Farrell is that markets are mean reverting, and clearly we're 3 standard deviations out of whack on interest rates right now. And so I do think that will reverse and that will correct itself.
Thanks, Glenn. Now we're right at about an hour. So before we close up, I just want to leave everybody with some resources that you have available to you if you do have questions. Number one, many folks don't know, but we actually have a podcast that we do. If you just search the Gordon Asset Management Podcast on Spotify, iTunes, wherever you listen to podcasts, you can find us there. It's very interesting because we invite a lot of portfolio managers for mutual funds, hedge fund guys, things like that on the podcast to give their thoughts on how they're investing money. So that's a great place to get insight about the markets. Also, we have a YouTube page where we put out video content there. And then last but not least, we have a pretty comprehensive blog at our website, wealthqb.com. So if you go there, click on the insights, you can see we pump out quite a bit of content. But then also, if you do have questions on our website, wealthqb.com, up in the top right-hand corner, there's a big schedule an appointment button. If you click on that button, you can pick a time and set up a call with somebody from our office to help. So again, check us out, wealthqb.com. And in the coming months and weeks, we'll actually do more of these live events to address your Q&A. We'll try to do them at varied times throughout the day so that folks with varied work schedules can join us. So that'll do it for today, folks. We really, really appreciate your time. We appreciate your business. And please don't hesitate to reach out if you do have any additional questions. So thanks a lot, folks. Have a great night.